And in today's currency report, you've heard it before, the story of risk playing out in the currency market. Today, risk is back on as stocks climb, commodity currencies and emerging markets currencies gain. And the safe haven slump, that would be dollar and yen. So when will the correlation between stocks and currencies break, and could a new trend be around the corner? Let's get to Jessica Hoversen. She's a fixed income and currencies analyst at MF Global. She joins us from our bureau in Chicago. Jessica, welcome to Bloomberg News.
Thanks for having me today, guys.
You say there are two key drivers of currencies right now. What are they?
The two key drivers of currency right now, obviously risk and also, I think, fiscal discipline. I think one of the things that continues to shock the market is how these countries are going to manage their exceptionally large fiscal deficits. If we look yesterday, the pound reacted to an announcement of their public borrowing, while it was one of the most depressed currencies of the G10s of the day, and I think that going forward, the market continues to focus on that. However, risk does remain the dominant driver, and it's risk over uncertainty, just basically uncertainty over policy, uncertainty over governments, uncertainty over corporate earnings, uncertainty over demand. And when does that break? I think as we move into the fourth quarter, the paradigm will slowly start to shift back to a focus on economic fundamentals. And why is that? I believe in the third quarter, if you look historically, there seems to be historically, it's demonstrated that the VIX, the swap spreads, the TED spreads have a tendency to widen in that third quarter. And so I wouldn't get in the way of the dollar and the yen in the third quarter.
Well, speaking of not getting in the way, is it all about stocks right now?
Yeah, unfortunately, it is all about stocks. I feel more like an equity analyst than a currency analyst right now. But if you do look at the S&P earnings, there has been basically a 7-to-1 on positive surprises, and there's lots of momentum. Material stocks have had a 5-to-1. Have shown 5-to-1 on positive surprises, and we've seen that play out in the Aussie and the yen. And I think that this segment of corporate earnings, this Q2, has really demonstrated that cost-cutting activities and basically these positive EPS surprises are allowing for some risk-taking. There's a lot of money sitting on the side. Still $3.6 trillion sitting in money market funds. People are very underinvested, and you've got a T-bill rate still hovering in these 18 to 20 basis points, and people want yield.
Jessica,
and so right now,
so that would seem to say to me, that correlation between what we're seeing in terms of the equity play and what's going on with the dollar, that if folks who are out there, there are those that are saying, stocks are going to head higher by the end of the year, that would mean we continue to see some pressure here on the dollar.
Definitely. I think that does, however, play out more in the fourth quarter. Again, if you look at the VIX historically widens out in the third quarter, and I think that this August-September period is a historical period of risk aversion. So as we digest this second quarter earnings, we are then forced to focus on what is really driving growth. The organic demand from the bottom-up perspective really isn't there. Right. Comments from 3M, from UPS suggest that they're really not seeing a bottoming. And so I think that the market's going to be forced to recognize that as we move into the remainder of the third quarter.
Jessica, we have about 30 seconds left. Quickly wanted to talk about the Canadian dollar. The Canadian currency rising against the dollar. That quarterly monetary report is due today. What are you looking for?
Well, the monetary report was actually just released, and it did show that the Bank of Canada does recognize that they're going to move out of this recession in the fourth quarter of this year. However, they're looking for they're basing their estimates on an 87. Basically a Canadian dollar ratio of 87 cents. It's at 91 cents right now. Right. So I think that those estimates will be skewed if this risk aversion or risk appetite continues to fuel the Canadian dollar higher.
All right, Jessica, thanks so much. Jessica Hoversen, analyst over at MF Global. Have a great day.